Welcome to Trading Nation. I'm Michelle Caruso-Cabrera. JP Morgan CEO Jamie Dimon out with his annual shareholder letter on Thursday. And Dimon commenting on interest rates, writing, quote, "It would be a reasonable expectation that with normal growth and inflation approaching 2%, the 10-year bond could or should be trading at around 4%. Also writing, quote, "I believe that many people underestimate the possibility of higher inflation and wages, which means they might be underestimating the chance that the Federal Reserve may have to raise rates faster than we think." What does this all mean? Mark Tepper is with Strategic Wealth Partners. Boris Schlossberg is with BK Asset Management. Boris, if the 10-year hits 4%, what does that mean for stocks?
Disaster. I think, if anything, people have been overestimating inflation and yields forever, and they continue to do so. Just to give you an idea, a 1% rise in yields wipes off $3 trillion of global wealth because the rates are so low. So I think it's highly unlikely we get to 4% anytime soon, especially because it's not just us. You have to remember the fact that Japanese rates are very low and European rates are very low, and the ECB is not going to raise rates anytime soon. So anytime U.S. rates tick up, the Europeans and Japanese come in to swoop up because they love to buy U.S. yields. So unless we see some sort of a buyer strike of U.S. security assets, which means that there's going to be some sort of a very big geopolitical refusal of U.S. assets, I very much doubt that we're going to see 4% anytime soon.
And that would be good news for the markets, because a 4% yield on treasuries could start to provide competition, right? If you can get risk-free and 4%, why own certain stocks?
Look, we haven't been able to make 3%. We've been trying to talk about 3% all year long, and we continue to just kind of come up against it and come back down. So to me, talking about 4% is way out of league. At this point, let's just try to see if we can make 3% before the end of the year, before we even consider 4% as a number.
Mark, what do you think?
I'd have to agree. I mean, I think 4% is just way too high. Our base case has the 10-year yield closer to 3.5%. So we're definitely firm believers in rising rates, growth, inflationary pressures, but 4% just seems way too aggressive for this year. And the reason being, we're experiencing very modest economic growth and very modest inflation. So I see very little incentive for the Fed to hike rates faster than anticipated. I mean, look at the spread right now between 10s and 2s. It's like 50 basis points. That's just way too tight. The bond market is basically pricing in zero economic growth. So, you know, we expect rate hikes to be gradual, and I'm not even sure we're going to see 3 hikes this year. I think it's possible that the Fed only hikes the Fed funds rate 50 basis points this year to avoid disrupting the whole growth story that's going on, especially given recent stock market volatility. So with that spread being so tight between the 2 and the 10, you know, maybe that would widen by 25 basis points or so. You add that to 2 rate hikes, and that gets us a little closer to 3.5. But I also agree, there's so much foreign interest and foreign demand in these bonds. You know, as an example, the Germans are going to see relative value versus their own 10-year of 0.5%. So, you know, that's going to help to keep long-term rates in check.
Yeah, we're showing viewers the 10-year, 2-year spread right now, and it's gone nowhere but down for the last several years. Gentlemen, thanks so much.
Thank you.
Our thanks to Mark and Boris for being here today, and thank you for watching Trading Nation. I'm Michelle Caruso-Cabrera, and we'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.